If you're self-employed and are nervous about the loan process, I'm going to explain why self-employed borrowers get turned down more often than their W-2 counterparts and how to avoid that when applying for a mortgage. Make sure to stay tuned to the end of this video to see some options that are available if your income doesn't quite meet the needs for a traditional mortgage. Now, first off, what actually determines you being self-employed? Essentially, what is considered self-employed? What do lenders look at when they're reviewing your income and employment? What documents do we use as lenders to verify that income? What happens if you have business expenses that report to your personal credit report? And as I said, what options exist outside of your traditional mortgage options that allow you to purchase a home with a mortgage when your income appears too low on your tax returns? So let's touch on who is considered to be self-employed. Well, naturally you think someone who owns a business is self-employed, but to be more specific, for a lender to consider you to be self-employed, you need to own at least 25% of the business. If you own less than 25% of the business, we do not consider you to be self-employed. So if you've applied for a mortgage, you own less than 25% of the business that you work for, or you technically own, and the lender told you didn't qualify because you don't show enough income, you might want to revisit that because you may actually qualify if the tax returns are removed from the picture. Keep that in mind. 25% ownership or more makes you self-employed in the eyes of a lender. Now, if you receive a 1099, so you do consulting work, or you think you work for a company, but you're not an employee of the company, you get a 1099 from that company, you are considered self-employed. You have an LLC and you file your income under your LLC, you are self-employed. You have an S-Corporation, you are self-employed. You have a corporation, you are self-employed. Now, what are lenders looking at when you apply for a mortgage with them? Well, for one, we are looking at your personal income earned from the business. We are not looking at your business's income. I want to be clear on that. There are often times I'll speak to a self-employed borrower, and in conversation when I'm going through the loan application process, which by the way is another video that I've done explaining what the buying process should be and the steps you should take during the buying process to not avoid mistakes that a lot of home buyers do make. One of those steps is making application with a lender to get pre-approved. So watch that video, make sure to subscribe. Now, let's just say you have made application. The lender is going to determine what your personal income is. And like I was starting to say, a lot of self-employed borrowers think their income is greater than what it actually is because in their eyes, the income that the business makes is their income, but that's actually not the case. Now, we're going to compare W-2 versus a 1099. What's the difference? Why is it easier for someone with W-2 income that does not own the business from which they earn the W-2 to qualify for a mortgage than it is for someone who's 1099'd? 1099 typically is going to be filed on your 1040, which is your personal tax return. More specifically, it's going to be on Schedule C of that 1040, and it's going to show on page 1 of the 1040 as other income. If you have an S-Corporation, which is common, you're going to file what's known as an 1120S. That's the type of tax form that you're going to file. However, an S-Corporation does not pay its own taxes. You pay the taxes for that corporation personally. So what happens is the corporation issues you a K-1. That K-1 goes onto your personal tax returns. You file the personal 1040 tax return and pay income tax on what you personally made from that. That's known as your ordinary business income. If you have a C corporation, it files an 1120, not an 1120S. The 1120 is going to show taxable income for that business. C corporations pay their own taxes. The income from a C corporation, because no K-1 is issued, does not show on your personal tax return. So I bring that up for a reason. There's a common mistake that a lot of lenders will make and then catch later on in the underwriting process of not realizing that someone might have a loss or positive income from a C corporation because all they've asked for are the personal tax returns. And looking on a personal tax return alone will not tell you whether or not someone has a C corporation because there will be no income or loss reported from that C corporation on the personal tax return. Now, we as lenders are also going to look at any add backs or any other deductions that need to be considered on those tax returns. Add backs are things such as depreciation, depletion, or business miles. Deductions that we need to take off of the income will be things like other income. That's income that's not going to continue going forward. A perfect example of other income that we see right now on a lot of tax returns are PPP loans. That's the money that businesses got from the government, the payroll protection program. Well, that's not continuing going forward. Those are 1 or 2 years in a row where that income came in, but it's not income that was actually earned by the business. So it's reported on a separate line of the tax return under other income. And we need, as lenders, to deduct that from the income that's usable for the mortgage. We also look at notes payable in under a year. Those are loans that were due to be payable within that calendar year, not outside of it. And we need to look at 50% of your meals and entertainment deductions, assuming you did not deduct 100%. Now, as of 2022, you were allowed to deduct 100% of your meals and entertainment expenses. Prior to that, it was 50%. So if you had $10,000 worth of meals and entertainment total for the year, only $5,000 of that was deductible, which means that we had to deduct the other $5,000 from the income. Let me walk you through some of these things because you may not be able to visualize W-2 versus 1099 or the different types of tax returns. So why is it that someone who has W-2 income has an easier time qualifying? So W-2 employees, we actually get to use all of the income that shows on their W-2 because taxes are deducted. Someone who's an employee of a business doesn't have the same advantage as a self-employed individual because they don't get to write off expenses that they incurred to do their job, right? If someone made $50,000 as a W-2 employee, they likely didn't have to pay to do the job. They don't own the business. They show up for work, they get paid their salary or they get paid their hourly wage, and that's it. They didn't have to buy the equipment or they didn't have to pay other employees to do the work, which comes off of the total they made. That type of borrower is 1099. 1099 means you're getting your full income that was earned without any deductions. It's your job to file your tax return, either self-prepare or hire a professional to do it, and let them know what your business expenses were. And those business expenses are subtracted out of that income. So let's just say you made $50,000, the same way as a W-2 person did. However, for you to make $50,000 as a 1099 self-employed individual, it actually costs you $20,000 because you had marketing expenses and whatever other expenses your business might incur in order to bring in revenue. Well, $50,000 minus the $20,000 in expenses leaves $30,000. So that's why the income for someone who's self-employed, let's call them 1099 in this case, is going to be lower, and it's more difficult in most cases for the person with a 1099 to qualify for a mortgage than the person with a W-2. Now, I mentioned that we're going to look at your 1040, which is your personal tax return. The income from Schedule C, which is the schedule that gets filed when you have a 1099, right? Schedule C, profit or loss from a business. Schedule C is for self-employment. It would show, here is where it would list the total amount of your 1099 and then all of your expenses that you incur. Once again, these expenses are deducted from this figure right here, and it's going to leave your taxable amount. The amount you pay taxes on is what the lender is actually using to qualify you for a mortgage. Now, I mentioned there are some things that can be added back to the income. So let's just say we use those hypothetical numbers, but maybe you have depreciation, right? Depreciation is a paper expense. It's not a real expense. It's something decreasing in value over time, right? It wasn't a real expense you incurred. We can actually add the depreciation or depletion back to this number. So if this number was $30,000 and you had $10,000 of depreciation, we add $10,000 and $30,000, that gives us $40,000 of income to use. Let's say your job requires you to drive a lot. You're an Uber driver. Perfect example. Uber driver, you get to deduct business miles. That would be claimed on page 2 of your Schedule C. We can add back your business miles at whatever the going rate per mile would be in any given tax year. Let's use 25 cents per mile right now. If you drove 1,000 miles in a year for business purposes at 25 cents per mile, we can add back $250 to your annual income. So if we do a combination, you had $30,000 plus $10,000 of depreciation plus another $250 of business miles adding back. Now you have $40,250 that we can use for qualifying. That's why it's important for the lender to review Schedule C and understand how to review someone who's self-employed's income, because if they only looked at your 1040, which is the personal tax return, and they looked here at line 8, other income, this is only going to reflect the $30,000 in this example, the amount after all expenses. It's not going to give the total with add backs or with other deductions you might have to take. So that's very important. That's for you if you have an LLC, you haven't established an actual S-Corporation, or you're 1099. You're reporting your income on Schedule C, and that's flowing through onto the first page of your personal tax return. Now, let's say you do have an S-Corporation, right? We talked about S-Corp. The S-Corp does not pay taxes, as I mentioned. You pay taxes personally. How does the IRS know the amount of tax you should be paid? It's based on how much income you earned from that business. Now, you can have an S-Corporation where you pay yourself compensation of officers, right? You're the officer of the business. You might pay yourself with a W-2 from that business. You're still self-employed though, so we have to factor in any income or loss that reflects on your K-1. Your K-1 is what's issued from that business to you for any profit that's left over after all expenses are taken out of that business. Now, you might have taken distributions throughout the year. Distributions are true money you received throughout the year, right? So whatever number's here, we can use. However, box 1 on the K-1 is the actual taxable amount of income left over from the business after expenses. If this is a negative number, that could be a problem because it shows that you incurred a loss to operate your business, right? So it's very important that the lender then review your tax return, which is your 1120S. So we looked at the K-1, it was positive or it was negative. Why was it positive or negative? So the figure that you see on K-1 is going to reflect here as your ordinary business income, line 21 of your 1120S. Those numbers should match the K-1 box 1 and your line 21 of the 1120S, right? That's first thing. We need to make sure those match, right? If they don't, then there's obviously some sort of accounting issue here, and you need to speak to your CPA or whoever prepared your tax return. If it was self-employed, you're probably going to need to amend and correct that. Those numbers should match. We're also going to look here at line 7, compensation of officers. This would be any money that you paid yourself, or if you had a business partner that you paid your business partner, it will reflect that. That's in the form of a W-2, right? So just like a regular wage earner, but you paid it to yourself. We can take that plus the K-1 or that minus the K-1 if it's a loss in order to determine your income. We do not look at your gross receipts. Common mistake. You're talking to a lender. Lender says, oh, you're self-employed. How much money do you make? Oh, I make whatever number reflected here. No, you don't. You don't make that amount unless you're running a business that has zero expenses, which is unlikely, right? Even if your business has zero expenses, your CPA probably deducts expenses because you want to reduce your tax liability, right? So if your business brings in $500,000, you don't make $500,000. You make whatever's left over after payroll, this, that, the other, right? So although your business brings in 500, you might actually make $100,000 personally. We use the $100,000 toward qualifying. Plus, of course, as I mentioned before, any depreciation or depletion, that's reporting. Now, there's something else we need to take into consideration when you have an S-corporation, and those are the notes due and payable in under 1 year. Where does this report? Well, this reports on Schedule L of your tax return. Mortgage notes in less than a year. The reason we have to consider this is this actually has to be subtracted off of the income that was made up of your K1 plus depreciation, depletion, and any W-2 income you would have had, because you had to pay that out in that tax year. So if you made $100,000 on a K1 and you had a $50,000 note due and payable in that year, now you only have $50,000 that we can use toward qualifying. So you have to be very, very careful and make sure you're working with a lender who understands how to read a tax return and qualify someone who is self-employed. Now, the alternative to an S-Corp is a C-Corp. That's a business that pays its own taxes. That's the type of business I mentioned will not show on your personal tax return, but needs to be disclosed to a lender, whether it's positive income or a loss, because it's the last thing you need coming up during the underwriting process. So we're going to look at, once again, the taxable income. Is it positive? Is it negative? If it's a loss, it needs to be deducted off of what you've made personally. If it's positive, we can add that back to whatever you made personally. So that will increase your qualifying income and make it easier to qualify for a mortgage. Just like an S-Corp, you can also have notes due and payable in less than a year, which have to be subtracted from that number. Now, what documents are needed to verify your income, right? So keep this really simple. General rule of thumb is that we need the most recent 2 years of filed tax returns. When you're self-employed, most lenders are going to get your tax returns from you, and they're also going to request tax transcripts from the IRS. The tax transcripts verify that the tax return you provided matches what the IRS actually received, right? Unlike someone who's an employee of a business where the lender is going to call and verify that that person actually works for the business, and we have recent pay stubs to support them still working for the business, the only way that we as lenders can determine whether or not you really filed that income or really had that income is to go directly to the IRS. So keep that in mind. Whatever you provide to the lender needs to match what the IRS received from you. Because it's so easy to make your own tax returns these days, a draft that you might have done in TurboTax may not be what you actually filed. So just long story short, make sure that whatever you're providing matches what was filed. Now, when we get the 2 years of tax returns from you, we're going to go in and we're going to average the income over the most recent 2 years. So as an example, if in 2021, you personally made $50,000 from your business, and in 2022, you made $100,000 from your business, we're going to add $50,000 plus $100,000, which gives us $150,000 of income, divided by 2 years. That gives us $75,000 a year of income. It's a 2-year average. However, if you've been in business for 5 or more years and you're getting a conventional mortgage, you automatically only need the most recent 1 year of tax returns. So here's a caveat: 5 years or more in business, conventional mortgage, automatically most recent year. Why does that matter? Well, your most recent filed year could be substantially better than the prior year. The numbers we're using here, right, 50,000 and 100,000, there's a big difference. It's doubling, but it's not a crazy difference between 75,000 for a 2-year average or 100,000 for a 1 year. But what if your business showed a loss in 2021. And now you're positive 100,000 in 2022. Well, if you showed a $100,000 loss, for example, in 2021, and then you made $100,000 in 2022, you average 100 plus negative 100,000 is $0. However, if you only need the 1 year, it's 100,000 versus 0. See the difference? So it's important that your lender understands these nuances. So been in business 5 years or more, guaranteed needing only 1 year on a self-employed conventional mortgage. There are times when you can get away with needing only 1 year of tax returns, showing at least a full 12 months of self-employed income with less than 5 years in business, but it's not a guarantee. So it's important you link up with a lender, go through the loan application process that I've discussed in some of my other videos in order to understand the steps you need to take. But once you've done that, they can let you know whether or not you can get away with just 1 year or you're going to need 2 years of tax returns toward qualifying for a mortgage. Now, what happens if you have business expenses that report to your personal credit report? Well, just about every self-employed individual is going to personally guarantee a lot of the expenses or debts that come along with the business vehicles or whatever else it might be. And those are going to report on your credit report. Naturally, you've personally guaranteed it. So it's going to show as your liability on your credit report. Do we as lenders have to hit you with that debt although it's covered by the business? Not necessarily. But here's how we can omit that debt from your personal expenses in order to bring your debt to income ratio down. So for one, they need to show as an expense on your business tax return. So us just saying, hey, this is paid by the business, or you showing a bank statement showing it paid by the business isn't going to cut it. For one, we need to show that it was a deduction on your personal tax return. And by showing it was a deduction on your tax return, it proves that the income showing on the tax return already factors in that cost or that expense, right? On top of that, we need to show 12 consecutive months of business bank statements with those payments coming out. If you have a car payment that we're saying is paid by your business and it's $1,000 a month car payment, I should be able to look at your business tax return and see a $12,000 auto expense, which is 1,000 times the 12 months in a year. And I should be able to also look at the 12 most recent months of your business bank statements and see the $1,000 car payment coming out of your business account every month, 12 consecutive months. If I can show that to an underwriter, we no longer need to count that $1,000 car payment in this example against you personally. And by doing that, it's going to increase the amount you qualify for because it's reducing your debt to income ratio. Once again, watch my video on how we calculate a debt to income ratio. So we've now figured out a way to get those debts out of the picture. But who knows? Do you actually still qualify? Well, maybe doing all that still doesn't qualify you for a traditional mortgage. So what do we do when that happens? Well, we look at alternative types of lending. One of the most common alternative types of lending that's available specifically for self-employed individuals are bank statement loans. You may have heard of these. These are loans where we'll look at either 12 or 24 months of your personal or business bank statements, add up all of the deposits coming into the account, and then subtract an expense ratio from that amount, and that leaves us with usable income. So an example, you have $100,000 in deposits over a 1 year period. That would tell us it's $100,000 of income, but we know that you're not operating a business at a 0% expense rate. It's not all profit, as nice as that would be. So let's just say that your CPA or your accountant provides us with a letter that states that your business expense ratio is 30%. We would take that $100,000, we'd subtract 30%, which is $30,000 in this example, and it leaves $70,000. We would then use the $70,000 as your qualifying income for a bank statement loan. So if the $70,000 exceeds the income that was reporting on your tax returns, we'll take advantage of the bank statement option in lieu of a traditional lending option. Because the income used on bank statement loans is based on your deposits, it's usually likely that the income derived from a bank statement calculation over your tax return calculation is going to be higher. And that's going to make it easier for you to qualify for a mortgage. So if you feel this information was helpful, whether you're self-employed or not, make sure to subscribe. You can also leave a comment below, and I respond to 100% of my comments. So if you have a specific scenario that you want me to check out, leave it below and you'll hear from me.